Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Dalen and Chris Hadding. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the Private Lenders Podcast. We do appreciate it. Today we are talking about creating A-plus opportunities. And the subheadline to that is from B borrowers. And I'll tell you what I mean. And people are probably thinking like, well, you just call your own borrowers like B. Like, here's what I mean by that. In this private lending world, when we're talking about A borrowers and B borrowers, using that terminology, A borrowers are doing dozens of residential deals every year. 25, 50, 75, 100. Like some of these guys do. Guys and gals do serious volume, have a big operation, crews, warehouses, all kinds of stuff. They're doing dozens and dozens of flips every year. And the institutional part of the lending industry, they are competing day in and day out to get business from those people. To like, you know, the kinds of things that we don't totally agree with. It's not our business model. It's fine that they do it, that they're competing for these folks. You know, pushing LTVs higher than what's safe or cutting their rate and points so low that they're barely making profit. That's their world. That's their world. And that's fine. They can have it. Go do that. And so when you take those people out of what we're talking about, then you're talking about the borrower. You do a handful of deals a year. Maybe you have, you know, a full-time job. Maybe you mainly own rentals and then you do, you know, a few flips. And that's kind of what we're talking about as B borrowers. We're not by any means being like insulting to our clients, nothing like that, not at all. So the question is, how do we take our base of borrowers, of clients, and create A opportunities, A plus lending opportunities to deploy private capital in a safe and profitable way? That's what we're breaking down.
Yeah, it's a challenging topic. We talked to a lot of members of the Mastermind group to and obviously help them with underwriting and determining, hey, is this a good deal? Is this not a good deal? You know, if you back up to original hard money, you know, just straight asset-based lending years ago, actually when we started, or even before that, typically it was just a collateral-based loan, right? And a lot of lenders didn't care as much on who the actual borrower is. It was like, hey, they buying a good piece of property, I'm in. Do I have 35% equity cushion? I'm in, right? A lot of lenders even looked at this as like a loan-to-own strategy. Hey, I'm going to lend as much as or as little as I would just buy this property for. So when institutions came into play and a lot of other money came into play, they kind of took a banking model into this, and we kind of adopted this early, you know, from the beginning, and we're going to discuss that as well. But the way that the institutionals come in is they just, in essence, will do loans to A-plus borrowers, someone with good credit, with experience, with cash, with a good personal financial statement. You know, they're very guarantor heavy, and obviously the real estate's the underlying asset. And it's important to kind of understand all of this as a mix, because like if you go to a bank and you have $1 million property free and clear and you don't have a good credit score, you're not going to get a loan. Or if it's a commercial building and it's vacant, you might not get a loan. Right? You could ask for $100,000 loan amount. It could be a 10 LTV and you might not get a loan, right? That's just the way that their underwriting model is set up. And it's challenging because like, what's better to have? A good credit borrower, a high experience borrower with maybe low credit, somebody with a lot of cash, but maybe has bad credit, right? Because just having good credit doesn't necessarily qualify you to be a good operator of real estate. A lot of people have good credit. That doesn't mean, right? So like the whole, you know, A bar or B bar or C bar, it's kind of a challenging thing to fully understand, and there's no right or wrong. What we're going to discuss is creating A plus opportunities, right? So taking the 4 C's of collateral, character, capacity, and credit, and molding that into an A plus opportunity. And like what Chris started the show off with is, you know, the Chiavis of the world, they're chasing high credit borrowers with good balance sheets and personal financial statements. And then in essence, they're willing to do very, very high leverage at very, very cheap terms. We're not, as private lenders. You know, we care about bottom line net profits on these deals. And we still want to make sure we're doing good loans to the right borrowers, but we can create A plus opportunities just like they can create A plus opportunities on different types of deals, and we're going to go through some of those, and so you have some really, really good examples. And this is something that's kind of intuitively have been with us for the last 20 years of this business, right? Because I'll give you an example of a very, very good A plus opportunity without an A borrower is you might have a real estate investor who's flipped a bunch of properties who doesn't have great credit. Maybe, maybe they don't have any credit. They just pay in cash. They don't really have any credit. Or maybe they had some credit card bills that they didn't pay, and they have $300,000 to their name, and they buy a property for $100,000 and it needs $50,000 in work. They don't have, they have a low credit score, and maybe they just kind of do the work themselves. They don't have a ton of experience operating real estate themselves, but maybe they've been a contractor for other borrowers or for other real estate investors or homeowners in the past, but they have a lot of cash, and they'll come to us and they're like, well, I couldn't get a bank loan. Institutional capital wouldn't work with me because I had a 610 credit score and I didn't have enough experience. And they'll come to us, and maybe we'll give them a lower quote because it's the first time borrower. They have some other things, but we'll turn this into an A plus opportunity by making them bring a lot of cash to the table to ensure that they, in essence, perform on our loan and on their real estate project. So maybe we'll do a loan of $100,000 and they bring $75,000 cash to close, and that turns into an A plus opportunity. And one might be like, oh, I don't get those deals, or who's going to bring $75,000 to the table? Well, believe me, that's lots of real estate investors we do. We did 20 of them this month that have plenty of cash to put into these deals, and they're thankful for the opportunity to be able to help them because other folks wouldn't. And there's an argument that a deal like that is a better opportunity than a high leveraged, high quality guarantor borrower, right? That in essence, you're giving a high leveraged deal to with very little equity and probably not making much money. There's less risk, arguably, in the lower quality borrower with the much lower LTV and a way lower exposure to the lender than a high leveraged, better quality borrower.
Yeah, I mean, at the end of the day, this is still asset-based lending. It's collateral-based. That's the first C. The first C is collateral. So borrower quality is important too, though. I'm not trying to knock that at all, because if you've been in the lending game for a while, how a bad borrower can bring down a good project, and you along with it, if you don't play your cards right in terms of leverage and everything else. But C still, collateral is still number one. We have to underwrite, assuming that the day after closing, the borrower is going to disappear. We'll never hear from him again.
Yeah.
If you're underwriting to that end and that you'll be okay. Now, you might not get every dollar that you're owed, all your default interest, everything else, but you're not going to lose money. The first mortgage lender is not supposed to lose money. And if you did, you made a mistake. And if we've ever taken a haircut, fortunately, there have been very few of those over the years, it's because we kind of made a mistake in some regard. Usually it's borrower related.
Yep.
But that's because we've always been so careful about collateral. I know a lot of people who we work with in the mastermind and everything else, if they look back and do a post-mortem on a deal that lost a few bucks, it's usually because of leverage. It's because they gave a loan amount that was too high. Typically ours is we did our loan amount right, but this borrower we should not have lent to. So just a few, thoughts as we're working through this topic.
They weren't sophisticated enough borrowers. And we looked at a deal this morning. We typically don't have collateral problems on anything
We really
that we do. But we do have borrower character problems sometimes that, we misjudged. Maybe we didn't go out and meet them in person. Maybe we got fooled, through a Zoom call. And again, not losing capital on deals like that, but they turn into headaches and not something we want to do. We had a deal in one of our markets today that I was talking to our originator partner, and he's like, hey, pick which ones we want. They've got 4 or 5 or 6 of these properties free and clear. We'd collateralize with all of them if we want. And our loan amount was going to be pretty low. We're going to be maybe a 30-ish, 40-ish LTV. And we're like, you know what? I think we should pass on this. I don't think this is the right borrower that we want to work on. These are crap. These are lower end, crappier assets and lower end quality borrower associated with them. And that was the challenge. Could we scrape out, from these things? Maybe, probably, yes, but it would have been a headache. Like, we don't want to work with not sophisticated borrowers. So when we say B borrower, that doesn't mean that they're not sophisticated. That might mean that they have dings on them. Yes. Yeah. They might have dings on them, like maybe they have a lower credit score. Why do they have a lower credit score? Let's go through that, right? We just did a really, really solid deal where the borrower was a $900,000 purchase. The borrower brought 500 something down. Our loan was like 4-ish, and they had lower credit. Had a conversation with them. They're like, they went through the divorce process. The spouse took a lot. They had to divide up stuff. They kind of like the situation worked out, or the situation was kind of unfortunate, which dinged the credit, but they still had a lot of cash to put into this deal, right? If they had no cash and bad credit, that's not an A+ opportunity. But we took a borrower that, in essence, on paper, I'm not saying in reality, they're B. On paper, they're B. To an institution, they're B. To a bank, they might be a B or C, right? And we took somebody in that situation and turned it into an A+ opportunity by increasing the down payment and structuring the loan that we would still be safe.
Yeah, I mean, it's looking at a given situation, a loan application, a conversation, whatever it might be, and seeing how to arrive at an A opportunity. Now, oftentimes it's not there. It's a numbers game. And we're going to talk about the numbers game for a second. This lending business is a numbers game. You just can't take any lead that you get today and turn it into an A opportunity. You have to have the discipline to move on to other ones and to focus on your marketing and everything else. Because we do speak to lenders in the mastermind group and people who come into our circle that they're taking the couple leads that they have and trying to create an opportunity out of it. And that's really not the right approach. That's not the way to end up with a quality portfolio. Quality portfolio comes from playing the numbers game, and the numbers game comes from marketing. So it's very common for people to say to us, like, yeah, I mean, how do you get people to put down X amount of cash? Like, when I talk to people, they're not going to bring that much to the deal. And the answer is, well, did you talk to 5 people this week or 50? Because if you talk to 50, you're going to have some opportunities in there that meet the mold, that meet your definition of an A+ opportunity that we're all looking for. You talk 50. If you talk to 5, it's probably not there. It's probably not there unless you get lucky. And how do we create all of these opportunities is from marketing. Like, for the longest time, we've been saying that marketing equals portfolio quality. Marketing is not, it's not for show. It's not because it's not an ego play. It's not because we like to be in content and it's not because any of that sort of stuff. It's not a performance, right? It's the gasoline for the engine. And I think a lot of lenders make the mistake of skipping over that. And they they equate marketing to somebody's version of like a personal brand. Although a personal brand too is not for show or an ego. Like, that is also a powerhouse source of business, but that's a topic for another podcast. But I think the right move is for people to get past that mindset as quickly as possible and realize that marketing is not an ego play. It is freaking gasoline.
Yeah, no doubt. And that's how you get A+ loans and A+ opportunities, by molding all of that together. I was talking to someone in the group recently. We do a good bit of outbound calling, and they were looking to do some outbound, and went through some tips on some stuff. Because a lot of people in the mastermind group, they think that they're trying to compete with Kiavi and the institutional lenders. They're like, I can't get any deals. They're getting them all. I don't want to lend out a 10-1 or 10-2. I was like, you don't need to. Like, understand, like, this is apples and oranges. We are not competing with institutional capital. We are their plan B, and be very transparent. If you're doing your scripting and you're talking to a borrower and you tell them, hey, I'm going to be 13-3. This is what our terms are. And they're like, oh yeah, that's a little bit high. And I'd be like, well, how much were you looking for? I was looking for maybe like 10-1 or something like that. I'd be like, hey, unfortunately, like, we're not that type of lender. We're a local lender. We use our own capital. We close quickly. It's a very easy transaction. If you're looking for cheaper capital like that, that's more of an institutional capital source. If you have several weeks to close and you're willing to go through all the paperwork, that's no problem. But if that's you, no problem. That's what should happen. And, think of me as your plan B lender. If for some reason you can't get that loan closed because they couldn't close quick enough, or maybe there was a big wholesale fee, and institutional back lenders don't like, paying big wholesale fees to on deals, or whatever the numerous reasons are. I mean, we get lots of deals that fall apart last minute because the borrower thinks they can go institutional. We had a deal that just fell apart that we're putting together now that they were going to do a DSCR loan, and he's going to end up just selling the property, but he needs more time. At this point, he's supposed to do a DSCR loan. I talked to him yesterday. The property is rented out to an insurance company who places tenants. Like, let's say there's like your house burns down and you have to move out of your house, and the insurance company, it rebuilds it, or strokes get it rebuild. They'll place you in this house that they have a lease on, and they pay above market rent to this landlord. It's actually a really, he's had it like that and rented out for a long period of time. Anyways, DSR lender wouldn't do it. He came to us. We're going to do like a 50 loan to cost deal form, loan to value / loan to cost deal form. So it ends up work. But point being is, you follow the script, tell them you're the plan B lender, and move on to the next one. So real quick, related to who I was talking about, quick story. Somebody in the Mastermind group, we were talking about outbound calling, and they asked for recommendations. And I was like, listen, we do a lot of stuff off SFR analytics. There's a lot of tools where, we'll get lists and do outbound calling to, to local real estate investors. And I was like, but don't, I was like, take the list. In Maryland, for instance, there's 6,000 real estate investor transactions over the last 12 months, right? Just in the state of Maryland. And obviously it's, you can determine who the buyers are, and you can ascend based on how many deals they did, from one deal to, I think the most in Maryland was this year, maybe 135 or 165 deals in one entity. It was something like that, called 100. I was like, weed out the borrowers that did one deal, and weed out anybody who did over like 8 deals, right? Start with someone who's done 2 to 3, 2, 3, 4, 5, 6 deals this year. That's your target audience. That's who you want to target. Because you better believe the borrower who's done 8 deals, 10 deals or more, they're using institutional capital. Can you get a deal from them at some point? Absolutely. There's lots of borrowers that we work with that where they're plan B and we get a deal from them. But like, don't waste your time on trying to sell yourself to them through an outbound sales call. Stick to the one-off real estate investors that do a few deals a year. There's still hundreds and hundreds and hundreds of those, maybe more, in every market that we're all in. Start with that if you're going to do that outbound sales strategy. Those are your target audiences, and figure out a way to turn it into an A+ opportunity. I mean, I can't tell you how many deals that we've done where somebody would be like, this isn't a great borrower, or there's this, or there's that. And it's like, you know what? There's one thing that might not work out great, but we're going to shift this into an A+ opportunity by structuring it. And it might work, it might not work, right? Like, dude, there's a deal, we learned this. We had a borrower that inherited a property worth $600,000. We gave him $100,000 early on in our career because he wanted to renovate the property. He had crappy credit, and he mucked up the whole thing. That wasn't a sophisticated borrower. It wasn't that he just had bad credit. He had bad credit and he wasn't sophisticated, right? But there's also people with good credit that are unsophisticated, right? So that's just one thing. The point is you still have to underwrite the whole transaction and spend time with the borrower on the phone or in person or over Zoom to understand their character and go through everything to see if there's a way to make it mold. Because it's not just about having a low LTV deal, right? Collateral, character, capacity, credit, they all play a role. If all of them are very good and they have low credit, if they bring enough cash to the deal and it's a good opportunity, we'll figure out a way to make it work, right?
Yeah, as I'm looking at our January pipeline, we had a solid month of January, closed 4-point-something million. Everyone on the team was putting up numbers, and there's a lot of creative stuff in there. There's some really good deals. We had a solid one, we had good loan amounts, solid month, and there's some creative stuff as you go through these different deal types. That's what we're doing now. It's early February, and we're still working through post closings from January because so many of them close right at the end of the month. It just goes to show you, like, if you know what you're doing and put common sense underwriting to these deals, there's some great opportunities out there, and truly control your capital, whether it's your own investor capital that you control. That's a big part of it too, because a lot of the institutional people and bank lines and stuff like that. Like they just can't get as creative as we can. So real quick before we wrap here, I do want to mention some of the live events that we have coming up. If you've been following this podcast for a while and are thinking about coming to work directly with us, we have some really, really cool events going on this year. There's one in Charlotte in May. There's one here in Maryland in our home market right here in our area in June. Go check them out at hardmoneymastermind.com. Click on live events. Now we run these mastermind styles. So there are speakers and there are presentations, but most of it is working with other lenders so that everybody can work to improve their lending business. It's not like a big conference, trade show where you just sit there for 2 days in the audience and listen to speakers and panels. It's not like that at all. Very, very interactive. You come, it's such, somebody in the mastermind said this a few years ago and it's stuck with me ever since, that masterminds are a cheat code, a total cheat code to skip ahead 5 or 7 years in this business in terms of knowledge and trial and error that you don't have to go through simply by coming to the meeting, learning from everyone else, asking your most important questions. If there's 2 or 3 things that you're working to improve in your lending business, just ask. You'll get 10 answers from people who have already been there. It really is super, super powerful. So if you haven't done so already, go check out hardmoneymastermind.com, click on live events, talk to Dave Bauer on our team. He'll walk you through all of the information for events this year. We'll see everybody next time here on the Private Lenders Podcast.
Thank you for joining us on this Private Lenders Podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders Podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.